the tax question. It's probably better than you think. Quick note before we start, I'm a real estate agent, not a CPA or a tax attorney. What I'm sharing today is general educational information. For your specific situation, please consult a qualified tax professional. I'll actually tell you how to find a good one at the end of this video. Okay, with that said, this is the question people are afraid to ask out loud because they're afraid of the answer. You bought your home for $180,000 in 1995. It's worth $430,000 today. That's $250,000 in appreciation. The question sitting in the back of your mind is, do I owe taxes on that $250,000? Most people I talk to assume yes, and most of them are wrong. The federal tax code has what's called the primary residence capital gains exclusion. Here's how it works. If you've owned your home and used it as your primary residence for at least 2 of the last 5 years before the sale, you can exclude up to $250,000 of capital gains from your taxable income if you're filing as single, and $500,000 if you're married filing jointly. Let me say that again clearly. As a single homeowner who has lived in your home as your primary residence, you can sell and keep the first $250,000 in profit completely tax-free. As a married couple, the first $500,000 is tax-free. So if you bought your home for $180,000, sell it for $430,000, your gain is $250,000. As a single filer, that entire gain is excluded. You owe 0 federal capital gains tax on that transaction. And even if the numbers are larger, say you bought for $150,000 and you're selling for $520,000, a $370,000 gain. As a married couple, with the $500,000 exclusion, you still owe nothing federally. This is why I say, for the majority of long-term homeowners in the Twin Cities suburbs, the federal tax situation is not the obstacle they think it is. There's one more concept worth understanding: your adjusted cost basis. Your basis isn't just what you paid for the house. It also includes significant capital improvements you made over the years. The $40,000 kitchen remodel, the addition you put on in 2008, that new roof, these all add into your basis, which reduces your taxable gain. So if you bought for $180,000 and made $60,000 in improvements over 30 years, your adjusted basis is $240,000. If you sell for $430,000, your actual gain is $190,000, not $250,000. Even more room under the exclusion. This is why it's worth digging up records of significant improvements, even from years ago. They may lower your taxable gain meaningfully. Now, what if your gain is above the exclusion threshold? This can happen if you've owned a high-value home for a long time, or if you've made substantial improvements. Gain above the exclusion is taxed at the long-term capital gains rate, not ordinary income rates. For most homeowners in your situation, that's 15%. Some higher income households pay 20%. Minnesota also has a state income tax, and gains above the federal exclusion may be subject to Minnesota's income tax rates, which range from about 5.35% to 9.85%, depending on your income. If you're in a situation where your gain may exceed the exclusion, you really do need to have a conversation with the CPA before you list. Not because the tax will necessarily be catastrophic, but because there are sometimes strategies available that can reduce what you owe. And you want to know those options before the sale, not after. One more concept that's worth understanding, especially if you're thinking about what happens when you pass this home to your children. When someone inherits a home, they receive what's called a step-up in basis. The heirs basis in the property is set to the fair market value at the time of the original owner's death, not what was originally paid. So if you bought for $150,000 and the home is worth $450,000 when you pass, your heirs receive it with a $450,000 basis. If they sell it immediately for $450,000, they owe no capital gains tax at all. This is actually one of the reasons some people choose to hold the home rather than sell it. If this is a factor in your thinking, talk with both a CPA and an estate attorney, because there are scenarios when selling now and deploying that equity serves you better financially, even accounting for this. Let me bring this home. For the majority of long-term homeowners in the Twin Cities suburbs, federal capital gains taxes on the sale of your primary residence are either zero or significantly lower than you feared. The $250,000 single and $500,000 married exclusion covers most situations. What you owe depends on your specific numbers: your purchase price, your improvements, your sale price, your income, and your filing status. That's why I recommend a conversation with a CPA before you list. Not to delay the process, but to start with a clearer picture. I work with several excellent CPAs who specialize in real estate transactions for seniors. I'm happy to make a referral as part of my free consultation. The link is in the description. And next week, the full money picture. Not just your home's value, your actual number. What will you walk away with after all the costs are paid? Most people never run this math. I'm going to walk you through it line by line. See you then.